We were just, quoting numbers to show that the developed markets have underperformed in November, but we have seen outperformance green on EM markets, and more particularly a big outperformance coming from India. You think this pattern can continue, Paul?
Yes, I do. So we've had a big overweight in India within Asia, ex-Japan, all year, which has been driven by superior earnings growth. Earnings growth that's also non-correlated with the global trade cycle. To be sure, a valuation premium, but a valuation premium deserved, in our view, largely because of its non-correlation with trade and sort of issues surrounding that. Inflation is also remarkably contained and will also benefit from the weaker oil prices.
Okay, by the way, Hang Seng slipping again. Let's see how that pans out. Adrian, good morning. We have seen some signs of outperformance of emerging markets versus developed markets, and within that, India outperforming emerging markets. Your thoughts on the entire universe?
Yes, so I'm actually very encouraged by the way EM is trading, particularly Asian markets, with the types of clues that we're getting out of Wall Street. So I think this does make a lot of sense as you look into 2019. The EPS premium that the US enjoyed over emerging markets is going to contract, and I think it's reasonable to assume some EPS premium out of EM. If you can get a stabilization and maybe a recovery come middle of 2019 in the Chinese economy, that would be very helpful. Perhaps trade tensions could also ease a little bit, which would be helpful for the big export markets of Korea and Taiwan. And I think for India specifically, you've got a huge macro tailwind here with the decline in the oil price. When we were having conversations 6 weeks ago, the conversations were very much focused about the high oil price, the weakness in the rupee, and perhaps risks around inflation in India in 2019. The movement that's happened in the oil price, I think, is going to help the rupee and clearly is going to be very positive for Indian inflation next year. So it does make a lot of sense that India is the leading market in Asia because it's the one that's getting the biggest benefit from the decline in the oil price.
Okay, so we have a consensus view that India is going to perhaps outperform. Gentlemen, morning. Paul, I was going through your note where you do expect a sharp slowdown in the US economy in 2020 with the possibility of a recession as well as early as Q4 2020. If there is a second leg of a global downturn, do you think that could take emerging markets, including India, down with it? And would that make you a bit circumspect to add fresh money into markets like India?
Right, it's a great question. So let me quickly sort of outline sort of the roadmap. We're sort of looking out to 2020. So very, very near term, we're seeing valuation compression in emerging markets down to sort of what we would sort of consider sort of trough valuation levels, which are around a bit over 5% below where we are now, particularly for those emerging markets directly affected by the trade war. We see risk-reward at those levels being somewhat better. We see over the near term the dollar continuing to be a little bit strong, driven sort of by the strong trade, the trade rhetoric. But we think we're not far off a dollar peak, at least for the short term, which should provide a certain degree of improvement in debt servicing burden in the EM complex, leading to some form of relief rally into 2019. So during that time, I think there is a scope for outperformance of primarily those markets that have underperformed. So it's probably not going to be India that outperforms in that context during that rally. It's more likely to be China, Hong Kong, Korea. And then I see sort of that plateauing, but by that time, we may actually have the fade in the U.S. tax cuts starting to sort of kick in, so that growth slows down from the first 3 quarters of this year at 3.3%, the current quarter around 2.5%, most of 2019 less than 2.5%, but still being kept alive by the U.S. tax cut effect. But then as that starts to slow towards the end of 2019, I think we'll see the focus return to the U.S. budget deficit. This should undermine the U.S. dollar further, and then provide some near-term or some tailwinds for emerging markets. So that emerging markets could potentially decouple from developed markets in the second half of 2019. However, during 2020, we see a much sharper decline in the global economy led by the US, with the chance of a recession by the end of 2020 or the beginning of 2021, in which case equities as an asset class, including emerging markets, will struggle.
Oh, okay. Let me continue what Paul is saying and ask Adrian about it. Adrian, this global growth scare that Paul is talking about, and probably an inevitable slowdown, do you think that's going to overwhelm positives like crude for India? And while we may outperform, it will still be falling markets, both EMs and India?
I don't. I think as I look at the global economy, you've got slow growth out of Japan and Europe. In Europe, you had some special effects around the auto industry in Germany. So Germany, technically in a recession, the last quarter it reported. I think you'll see slightly better growth out of Japan and Europe going into 2019. Within the EM world, I would also expect to see some pickup, with perhaps China being the most important data point to be looking at there. The slowdown in the US is simply that you don't have the fiscal impulse that was brought into place by the Trump tax cuts. I think that's something that's in everyone's forecast, so I don't see that really being a surprise for the market. When we look at the underlying economic data in the US, you've got a tight labor market, rising wages, so the consumer remains strong, and that's the dominant part of the US economy. My fear around recession would really only come into place if you began to see US inflation data forcing the Fed to tighten. I think that is a risk, but at the moment it looks like a contained risk. Obviously will be helped by the fact that the oil price has fallen, which will help headline CPI in the United States. So I'm more sanguine about this. I think markets are sort of giving you a message, particularly in Asia, which is buy on dips. I think something you were making as a point in the introduction. So the base case, actually, I think, is okay economies, but clearly not as stellar an economy as we had in the United States in the first half of this year.
Adrian, that's an interesting point. Since you do look at a lot of these Indian stocks and sectors, I just wanted your thoughts on the consumption basket in India, because that went through a brutal correction and is now showing signs of life once again. You reckon the valuation drawdown is now enough, and is it still a good space to now buy?
Before addressing valuations, I think we need to consider the delta that's going on here. What is changing? So what is changing is the oil prices come down, the pressure on the rupee is easing. So I think there will be a rotation from the export earning sectors towards domestic sectors. You made a point about the bank indices doing better in India. So I think financials, domestic names will do better in this environment as portfolio managers shift capital from exporters. Now, with regards to consumption, again, the delta there is positive. The risk to a decline in discretionary income in India as inflation rose into 2019 should diminish with this decline in the oil price, particularly if the rupee stabilizes. So I think there are some really good macro reasons why you'll get a rotation in that direction, rather than necessarily a rotation being driven by valuations.
Okay, then one final question to you, Paul. We got your overweights and underweights, but in 2019, what would your pecking order look like? Where would you put money first, and which market would you avoid entirely?
Right. So I think so. In terms of, I just addressed the last part there. The markets which we've been heavily underweight during this phase of a very strong dollar have been sort of the twin deficit countries that have seen deteriorations in both their fiscal deficits and also their current account deficits. So Philippines was our bottom ranked market in the region for this year. That continues because we still think the BSP is significantly behind the curve. However, one underweight there, Indonesia, we do see as being, along with India, as being one of the key beneficiaries of falling oil prices. Also, sort of given sort of the direct effect on the fiscal balance there, namely that there's an election next year, some promises that domestic gasoline prices would not be increased. While at the same time we had seen, quite strong oil prices as putting pressure on the fiscal balance, and then we sort of had an overall continued deterioration in the twin deficits. That should reverse somewhat. We're still underweight there, but we're sort of watching the macro picture there improving. Also, where we think that the central bank is doing the right thing was positive real policy rates there. Which is encouraging. But I think in terms of the way our map is sort of mapped out for next year, we think, to qualify, we think that emerging markets will do okay in 2019. The first half will be probably led by the North Asian names that I've mentioned, during some form of relief rally based on some form of ceasefire or détente on trade, Korea and China in particular within EM, but also Hong Kong. But then later in the year, I think the focus will then come back to the premium associated with growth. Now, I don't see the risk in the U.S. as being sort of a pricing one through the Fed. I actually see it as being risks actually on the growth side, and particular a potential sort of for a credit shock to kick off some form of growth problem, maybe not in 2019, but in 2020, and there are some systemic risks there. Okay. But I think India will do actually quite well, particularly in the second half of next year.
Okay, well, Paul, in that case, just give us one near-term view. This growth scare that has taken off all that the Wall Street indices gained this year, and that continues right now in the Asian indices. This is a dip you would buy, or do you think this gale can continue for some more time?
I think it really depends on how quickly we get some form of resolution on trade. So when we look at the simulations on the impact of a trade war on GDP growth, these are usually sort of assumed 12 months imposition of tariffs. Now, the longer the tariffs are actually imposed, the greater is the challenge for growth. So for me, again, this is the real risk. If we get a resolution at G20 in a week or so's time, then there's scope for quite a significant rally. If it lingers on, beyond, let's say, Chinese New Year next year, then I think that the chances of there being a sustainable rally are fairly limited in global equities. Now, as I mentioned, there is a chance for EM to decouple because I think the dollar is towards the end of its rally. It may have potentially peaked now. I think it's unlikely, but possibly over the next few months, in which case we could see a decoupling. Now, so long as global growth is still okay, now the IMF is downgraded to around 3.4%. That's still pretty good. And U.S. growth next year should be a touch below 2.5, which is okay as the stimulus from the fiscal cuts in the tax cuts in the U.S. is still there. But that really drops out in 2020. So I think next year could be okay. We could have EM decoupling, but then following there, I think there are significant risks to growth.